everyone, in today's video I'm responding to one of our viewers' questions about spousal RSPs, specifically what happens when you start cashing them out. I won't be going into detail about what a spousal RSP is in this video. We have another video on that which I would encourage you to check out first before you watch this one. The first example will be for those of you that have either never taken money out of the spousal RSP before, or maybe you haven't made a withdrawal from the account in a long time. The second example will show you what happens when you've actually already made a withdrawal from the account recently. Now, to make things simple, when I'm referring to you, I'm referring to the higher income earning spouse. So when I mention spouse, I'm referring to the lower income earning spouse on the account. So let's get right into the first example. The year's 2021 and you want to withdraw $20,000 from the account. Every single year you make deposits into the account worth $5,000. Including the year 2021, the same year you want to take money out. So who pays tax on that $20,000 then? Anytime you want to know who has to pay tax on money when you cash out the spousal RSP, the first thing you should do is ask yourself this question. I'm taking money out of the account this year. Did I make any deposits this year or in the 2 previous years? If the answer to that question is yes, then some, if not all of what you take out will likely be added to your income. But how do you know how much though? To figure that out, you first need to add up all of the deposits that you made in the year you want to make a withdrawal plus the 2 previous years. Now in this example, the total is $15,000. Next, you compare that number to the amount you want to take out, which is $20,000. Whichever number is less is the amount that's added to your income. If there's a difference between the amount taxed under you and your total withdrawal, then the difference will be added to your spouse's income. So in this example, $15,000 is taxed under you, and the remaining is taxed under your spouse, the $5,000. Now, had you only withdrawn $15,000, then the full amount would have been taxed under you and nothing would have been taxed under your spouse. Let's move on to our next example. Now, in this example, you're making a withdrawal from the account, but you already made a withdrawal last year. Now, some of you are probably thinking, since you already cashed out money last year, then all of it must be taxable under you. But as you're going to see, that isn't actually the case. So we're still in 2021, except this time, not only are you taking $15,000 out, but you already took out $14,000 last year. Now this example is a little bit more complex, but we don't want to overcomplicate it. We always start by asking the question, did I make a deposit this year or the 2 previous years? Now in this example, the answer again is yes. So you already know that you're going to have to pay tax on some of that money that you're taking out, but on how much? To answer this question, we first need to understand what happened with that withdrawal in 2020. Not only did you make a deposit that year, but you did also make deposits the 2 previous years. Okay, so here's where it gets a little bit complicated, but stick with me. I'm going to break it down really simple for everyone. Anytime you're comparing your withdrawals to your deposits, you always want to start with the furthest of the 2 previous years and then start working your way up to the current year. This is important to understand, and you're going to see why in a second. That $14,000 is going to be held against you starting first with your 2018 deposit, then your 2019 deposit, and then most of your 2020 deposit, with only $1,000 left since you withdrew $14,000 out of the $15,000 that you deposited over those 3 years. The full $14,000 would have been added to your income in 2020, the same year you made the withdrawal. For your 2021 withdrawal, we do the exact same thing. We look at 2021 plus the 2 previous years, 2020 and 2019. You made a $5,000 deposit the same year, and you also made a $5,000 deposit in the 2 previous years. However, most of the money, with the exception of $1,000 left in 2020, was already added to your income last year, so it can't be added again. You can't be taxed twice on the same deposits. Which means, in this example, none of the deposits in 2019 will be held against you. Only $1,000 from 2020 is available to be taxed against you, and then you have the full $5,000 of your deposits available in 2021 to be taxed under you. So the total amount of taxable deposits is $6,000. Just like before, comparing the deposits to the withdrawals, $6,000 is lower than the $15,000 that you're withdrawing. So the smaller amount, the $6,000, is added to your income. Since there is a difference between the amount being added to your income and the total amount that you're taking out, the difference, which is $9,000, is then added to your spouse's income.